Good evening and welcome everyone. Is the audio and video clear? Yes, thank you. So today we'll be moving ahead with our basics of options, and what I want to share with you today is something which is a bit of an advanced topic if you consider it so in terms of options. So just give me 1 minute. Yes, so I'm sharing my screen. Please let me know if the screen is visible. Yeah, so is the screen visible? Yes, thank you. So yesterday we did some basic learning about options, and one of the things which we learned about option was moneyness of the option and break-even points. From the moneyness of the option, now I'm sure you might be knowing that moneyness depends upon how far the option is from the current market price. So the option, the strike price of the option, which is closest to the current market price, is at the money call option. And all the call options which are having value less than the current market price are in the money. All of the call options which are having value more than the current market price are out of the money. Now, moving ahead with yesterday's teaching, today we are going to build up upon it, and we are going to see something which is called as how do we see the option chains, and what is it that we want to have an idea about when we look at an option chain. So let me tell you how I study option chain. So when I look at option chain, I start with the basic that the center piece is the strike price, and all the options are arranged in a ascending order, the smallest one being at top, the largest one at the bottom. After that, the first thing which I want to see is the open interest. Then this is the call side open interest, and this is the put side open interest. So this open interest, when I say open interest, what does open interest means? Open interest simply means how many contracts of this particular strike price are open in the market. So, for example, if party A starts the day and he sells 3 options, so somebody will be buying 3 options. So the total OI will be 3. 3 sold, 3 bought. Now, after some time, party B comes and it sells 10 call options, and there are about 4 people who buy these, like 4, 4, 1 and 1. So now the open interest was 3 previously and 10 now. So open interest now becomes 30. Now after some time, the person A who had 3 open positions, he closes his position, and this position is closed and it is bought by C. The C person buys the open positions of A, and these positions are closed. So now from 13, it comes to 10 again. So OI is a dynamic thing, and it goes on changing constantly during the market hours. Now, just to give you a basic idea, whatever OI is present, we consider it the position of an option seller. So if at 2340, the OI is 1281, it means 1281 lakh contracts are open at this strike price. So what do I mean by that? That 1281 lakh people have sold a call option. call option has been sold. And at the similar strike price, about 2060 people have sold put option. So this means that if Reliance tries to move from about 2340, 1281 lakh people will be trying to protect this level. On the same side, 2000 people will be trying to cross this. Okay. Rather than making it more confusing, let us go and see a live example so that the things become clearer. So let us go and see something which is going on presently in the market. So if you see this, let me take you to the option. So Bank Nifty is presently trading at 42,733. So let me remove everything. So 42,700 is something which is presently the at the money strike price. Now, what do we do when I want to read this? I start from the center, from the strike price, and I see which strike price is closest to current market price. So this is the strike price which is closest to current market price. Now, what is happening at this strike price with relation to the OI on the call side and OI on the put side? So if we see here, there are 22,66,150 contracts which are open on the call side. At the same time, there are 18,51,300 contracts open on the put side. What does this mean? This means that this 42,700 level is being protected, and people now, what is the role of a call option seller? Will a call option seller want the strike price to go? Will the call option seller want the Bank Nifty to go up or want the Bank Nifty to stay below this level? A call option seller, will he want Bank Nifty to go above 42,700 or stay below 42,700? Come on. Yes. All option sellers will always want that the price should stay below 42,700 levels. So at this level, 22,66,000 people are protecting 42,700 level. That means they are preventing Bank Nifty from going above 42,700. At the same time, 18,51,000 people are trying that Bank Nifty should cross this level, should not stay below 42,700. So you can imagine that this is a war kind of thing, and this is the place at which the war is happening. There's an army of 22,66,000 people here and 18,51,000 people here. They're fighting with each other for this level. If these people win, the call side win, then Bank Nifty will stay below 42,700. If people on the put side win, the Bank Nifty will cross 42,700. Now, why do we say that this is the level of sellers? Because no doubt, for every seller, there is a buyer. But who requires more money? Who requires more money? Definitely, yes, a seller requires more money. And who is taking more risk? A seller is taking more risk. Definitely. So if the person who is ready to take risk is using bigger capital, is having more money and power, then definitely he is the one who will be in control of that option. So whenever we say open interest, we always consider open interest in terms of who is having greater influence at that point. So open interest is considered as having the influence of sellers. That is why when we say open interest is for at 42,700, call open interest 22 lakh, we mean 22 lakh all sellers are present at this. Okay. Now, after I have done this, I have realized that at 42,700, at this particular moment, the call option sellers are a bit more powerful than the put option sellers by about 4 lakh contracts. Now, next thing which I want to see is how do I get to know where is the next immediate support and resistance. So if I go below this, I will see there is 34,96,000 open interest. So next big resistance for Bank Nifty is at 42,800 level. Similarly, if I go on the upside, then I will see that the next big resistance, next big support for the Bank Nifty is at 42,500, which is 35,80,000 contracts. So here 35,80,000 people are protecting 42,500. So immediate support for Bank Nifty is at 42,500. Immediate resistance for Bank Nifty is at 34,96,000. What is the biggest resistance? The biggest resistance is 54,90,000 contract present at 43,000. So generally the round figures, if you see 43,000, 42,500, 42,000, these are the contracts which have open interest comparatively higher than between strike prices. Here also if we see 42,700 has 22 lakh, 42,800 has 34 lakhs, but 43,000 has 54 lakhs. Here also if we see 42,700 has 18 lakhs, 42,600 has 17 lakhs, but 42,500 has 35 lakhs. So round figures strike prices, generally they tend to act as greatest support or greatest resistance. Okay, clear till here? Are we clear till here? Great. Now we have seen how we decide about what is call option, how is the level of support, where is resistance. Now, how do we decide what is going to be the trend in the market? Now, I just told you that this OI is not constant, it is dynamic. So this goes on changing, and every 2 minutes or 3 minutes, this data we will get, the change will be reflected in this chart. What we will do, we will study it at an half an hour interval. Suppose if the market starts at 9:15, then the next we will see at 9:30, and from 9:30 onwards, after every half an hour, if we go on seeing what is happening with this OI, then we can get a fair idea about what is the market sentiment. So for example, the market starts tomorrow and this is at the money strike price right now. Okay. So if at 9:30, I see that this call OI, which was 22 lakhs, now it has become 34 lakhs. And this 18 lakh has decreased to 10 lakhs. What will it mean? It will mean that the call OI is increasing and put OI is decreasing. If call OI is increasing and put OI is decreasing, then it will mean that the people who are protecting the bank nifty or defending the bank nifty levels from 40 to 700, they are becoming stronger. That means they are more confident of either keeping bank nifty below 40 to 700 or maybe even below 40 to 600, 40 to 500 levels. But they are increasing in number. So I get an idea that the market is likely to go down. Okay. This is how we can judge what is the trend of the market, and we can take a view about market sentiment that is going on. Now, exactly opposite. If I see that at 9:30, this 18,000 has become 28,000. And this 22 lakh is 18 lakhs has become 22 lakh. And this 22 lakh is now 18 lakhs. It means the put OI is increasing. It means the people who are trying to keep bank nifty above 40 to 700 are becoming stronger. So market is likely to go up. So if call OI is increasing, then the market is likely to go down. If the put OI is decreasing, if the put OI is increasing, then the market is likely to go up. Clear till here? Clear till here? Give me a yes. Yes, thank you. Now, there are certain things which can happen. If the call OI is increasing, okay? First of all, I want to understand whether you have got this very clear. If the call OI is increasing, what does it mean? Call OI is increasing. Means call sellers are increasing. If call sellers are increasing, they will try to keep the market down. Great, very good. What will happen if put OI is increasing? Put OI is increasing means put sellers are increasing. If put sellers are increasing, it means market will go up. Yes, very good, very good. Ramesh ji, Rajendra ji, Rakesh ji. Very good, very good. Hariharan ji, very good. Now, there are certain situations which can happen, and those are the ones which we should look out. So if the call OI is increasing, but put OI is not decreasing, then it is likely that the market may remain sideways. Similarly, if put OI is increasing, but call OI is not decreasing, call OI is also remaining same, and put OI is increasing, then it means that the market might remain sideways. Okay, so what all situations can happen? Let us see. Call OI and put OI. Okay, OI of call is increasing and put is decreasing, then market is bearish. Very good. If call OI is decreasing, put OI is increasing, it means market is bullish. Okay. Now, if call OI is increasing, but put OI is not increasing, or if put OI is increasing and call OI is not increasing, then sideways market. Okay. Now there is also a fourth situation in which both the call as well as the put OI are increasing together. Call OI is also increasing and put OI is also increasing. Both the OIs are increasing. So this is a situation where we see a number of bull traps or bear traps. Bull trap or bear trap situations occur in this kind of situation, where both the OI are increasing. Got it? Clear? Okay. Now, yesterday we saw something which is called as option Greeks. And during that option Greek, we learned that the option premium is decided by two things. One is the intrinsic value, which is the inbuilt value of the strike price based on how far is the strike price from the current market price. Intrinsic value is the one which is not affected by the expiry much. It is the value which a strike price has in itself. Extrinsic value is the one which is having variations depending upon how much time to expiry is there and other Greeks. What are the other Greeks which we saw? We saw that the other Greeks are delta, theta, gamma, and vega. These are the four Greeks which we saw, and the last one was rho, which if we are doing intraday trading or small positional trade for 2-3 days or 5 days, won't make much of a difference, but rho is related to the interest rates. Okay, these are the four Greeks which everybody talks about, and these are the Greeks which are important, out of which we saw in detail about delta yesterday. And what is delta? Delta tells us how much movement will there be in the premium with respect to the movement of the underlying. That we saw. The value of the delta is approximately 0.5 at the money call option. At the money options are generally 0.5 delta. So even if you see here, then this is approximately 0.5. Okay. And as we go in the money, sorry, this is rho. This is delta. And if you see, this is at the money call. And at the money call has 0.55 value. And at the money put, if you see, even that is having close to 0.55 value. Okay. As we go in the money, now listen to this very carefully. As we go in the money, the value of delta increases. As we go out of the money, the value of delta decreases. Now, other three Greeks, these are called as second order Greeks. Delta is a first order Greek. Delta is a first order Greek, and the other three are called as second order Greeks. What do you mean by first order and second order? First order means delta is directly affecting the premium based on the strike price. So it is the first order. But gamma, vega, and theta are not directly affecting the premium. They are affecting it through delta. Like we saw, what is gamma? Gamma is rate of change of delta. So gamma is ultimately dependent on delta. Similarly, even vega and theta are dependent on delta. How? Let me show you. If you see this, this is 42,700. 42,700. Now let us have a look. Leave this delta for a while. Okay, we already saw about delta. So let us not consider delta at this point. But if you see all these three, which are second order deltas, which is the highest value of theta in all these? The highest value of theta is at 42,700, which is at the money. As we go away from at the money, in the money side also and on the out of the money side also, what is happening to theta? Can somebody see and tell? This is the value which is highest of theta at 42,700 call option. What is happening to this value as we are going in the money and as we are going out of the money? Exactly, they are decreasing. So what does this mean? Theta is decreasing when we are going in the money also, when we are going out of the money also. This means that the effect of theta is maximum at 42,700. In simple terms, which call option will be affected most by decreasing time of expiry? Which call option will be affected most by decreasing time to expiry? Yes. Yes. Weekly, but which one? According to the money one, which one will be affected? Whether out of the money will be affected most, at the money will be affected most, or in the money will be affected most? Yes. So people who think out of the money need to pay a bit of more attention, because just now what we saw, 42,700 is at the money, and the value of theta is also maximum at the money. So the option which is affected most by theta, which is with the premium, will be affected most by the time to expiry, will be at the money. And Ravindraji is right when he says at the money call option will have the maximum effect of theta. Not only theta, if you see even vega, then what is happening? The effect of vega is maximum at the money. What does this mean? This means, imagine that Bank Nifty goes from 42,733 to 42,833. So what will happen? This call option, which is at the money right now, will become one strike price in the money. So the effect of vega, that is the rate of change of delta, the price which will affect delta from 0.55, it will become 0.65 or 0.60. This will be happening maximum at the money. Getting this concept? The option price change will be maximum at the money. The effect of expiry will also be maximum at the money. What does this mean? That at the money contracts are the most sensitive to extrinsic change. When we say sensitive, it means they will increase also very fast if there is change in vega or gamma, and they will decrease also very fast if there is change in vega and gamma. Theta is anyways going to decrease only as the time to come, as the time to expiry comes nearer and nearer. Theta is going to go on decreasing only. But what is the maximum effect having, which is the strike price having maximum effect of theta? At the money. That is the reason why I am telling you this, because why do we do straddles? Why do we sell at the money calls only? We prefer to sell at the money calls. When we say that we are doing straddle and we are selling at the money call and put, we are doing so because effect of theta, vega, and gamma all are maximum at the money option. On both the side, if you see, it is maximum at the money option. So the chances of getting premium by us is more, because they are sensitive. At the money are more sensitive. Vega is related to volatility. So what will happen? if volatility increases, the premiums will also increase. But like we saw in delta, the price change is not happening equally in all the options. It is happening more in the money, less at the money, and least at out of the money call options. But if we see what will be the effect of volatility, if there is a volatility spike in the market, the premium will increase. But which premium will increase the most? The premium at the money call option and put options will increase more because of it. Got this concept? Is this concept clear? This is a very important concept which very few people understand, and they are able to use it practically. Okay. So this is the whole reason of selecting at the money strike prices. Now, if you are getting confused, a simple way to remember is delta is clear. Delta is first order. So first order is 50% at the strike, at the money. That is 0.45 to 0.55 is the delta at the money. You know, 0.55 तक at the money पे रहेगा. डेल्टा का प्रीमियम पर इफेक्ट क्या है कि 100 पॉइंट बैंक निफ्टी बढ़ेगा तो एट द मनी 50 पॉइंट बढ़ेगा. क्यों? क्योंकि डेल्टा 0.5 है. जैसे जैसे इन द मनी जाएंगे वैसे वैसे डेल्टा का वैल्यू बढ़ेगा. तो इन द मनी का प्रीमियम ज्यादा बढ़ेगा क्योंकि डेल्टा का वैल्यू ज्यादा है. आउट ऑफ द मनी का वैल्यू कम बढ़ेगा. क्यों? क्योंकि एट द मनी से कंपैरिजन में आउट ऑफ द मनी का डेल्टा कम है. क्लियर? नाउ व्हाट विल हैपन टू अदर सेकेंड ऑर्डर ग्रीक्स? सेकेंड ऑर्डर ग्रीक्स, second order Greeks, if you are getting confused, then just remember, okay, you are standing at a station and a train is coming and moving from front of the station and going away. So the sound of the train will be maximum where? Where will be the sound of the train maximum? आप एक स्टेशन पे खड़े, एक ट्रेन आ रही है और प्लेटफॉर्म के सामने से होते हुए आगे जा रही है. सबसे ज्यादा आवाज ट्रेन का कहाँ आएगा? हाँ, इंजन के पास. बट आप जहाँ खड़े हैं प्लेटफॉर्म पर, सबसे ज्यादा आवाज स्टेशन पे रहेगा, है ना. तो दैट स्टेशन इज एट द मनी. एंड फॉर सेकेंड ऑर्डर ग्रीक्स like gamma, vega and theta, the maximum value will be at the station. It will be least from away the station. Station से 100 meters की दूरी पर it will be less than what is at the station. 200 meters will be less, more. It will be more, will be going on decreasing as we go away from the station. Similarly, when the station is crossed, after 100 meters, the sound of the train will go on decreasing. After 200 meters, sound of the train will go on decreasing more. After 300 meters, we will not be able to hear the train. So imagine vega, theta and gamma, vega, gamma and theta to be like the train which is crossing the ATM. When they are at the money, their value is the maximum. As they are away from the at the money, either in the money or out of the money, their value is least. है ना. यही हम ये टेबल में भी देख रहे हैं कि एट द मनी पर इनका वैल्यू सबसे ज्यादा है. इन तीनों का वैल्यू सबसे ज्यादा है. जैसे जैसे वी आर गोइंग इन द मनी, द वैल्यू इज गोइंग ऑन डिक्रीजिंग. जैसे जैसे वी आर गोइंग आउट ऑफ द मनी, द वैल्यू इज डिक्रीजिंग. Here also value is decreasing. 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 Okay. So second order Greeks have the maximum impact at the money. Okay, and first order Greek has maximum impact deep in the money. सबसे ज्यादा डेल्टा सबसे अंदर के कॉन्ट्रैक्ट्स के लिए, सबसे एट द मनी पे 50% ही इम्पैक्ट है डेल्टा का, और आउट ऑफ द मनी पे और कम होता जाएगा. नाउ इमेजिन what will happen if Nifty starts moving from 42,700 to 43,000. As soon as this starts moving, this delta, which is 0.5, when Bank Nifty goes to 42,800, this delta, will it remain 0.5? Will this delta remain 0.5? No, this will become 0.65, close to 0.65. When this goes from 42,800 to 42,900, it will increase from 0.65 to 0.75. That is why the premiums will also increase from 217 to approximately 270 to approximately 360. Okay. So one way of guessing how much will be the value when Bank Nifty moves from 42,733 to 42,833, that is a 100-point move, is by looking at the premium. So it will move from 217 to 273, approximately this much. When it goes from 42,800 to 42,933, it will become approximately 361. Okay, if it goes from 42,800 to 42,700, this 176 will come down to 139. Okay, this is how we judge how to calculate the value of the price of the premium when the Bank Nifty or an underlying is moving. Clear? Had any one of you used this type of ways to understand or calculate how to calculate the premium? Yes. Okay. Good. 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 So yeah. Okay. So moving ahead. Now we come to another concept. Now this is all what I have told you is same things which is there in the slides. First order Greeks, second order Greeks, and this is just an example to show you why I have taken so much time to emphasize on the roles of delta, theta, vega, gamma. So suppose we are trading in Reliance Industries and we are considering two scenarios. One is that we are going to close the position intraday and we are going to see what is the impact if there are 5 days left for expiry. Okay. So we are entering 2400, where we are entering at 2400 and we are exiting when Reliance reaches 2450. Okay. Same thing we are going to see what happens when we exit intraday and what happens when we exit when there are 5 days remaining to expire. So if we consider deep in the money options, like for example, Reliance is presently trading at 2400, we are buying 1800 call. Then what will happen? Suppose we buy it at 204 rupees. Then if Reliance moves from 2400 to 2450, then we get approximately 50 rupees move because we are deep in the money. Approximately 0.95 will be the delta. And what will be the return on investment? In deep in the money, it will be approximately 25% return on investment. But if there are 5 days left to expiry and we are buying at 204 and we are exiting, then there won't be much difference, but there will be some decrease in the return on investment. Because we are deep in the money, the impact of theta, that is the impact of days left to expiry won't be much. But if we consider a in the money option, this is deep in the money. So Reliance is trading at 2400 and we are buying 1800. Now, if we are coming closer to the strike price, then if we enter at 110 and we are looking at an intraday movement, then we will not get full 50, we will get somewhat 46 points and it will be 41% of the ROI. Whereas if there is 5 days left to expiry, we will get comparatively lesser, just 4 points lesser, but the ROI will be decreased by 37%. So in the money and deep in the money, not much difference in the ROI, just a difference of 2 to 4% as compared to 5 days to expiry and intraday. Clear? Okay. Now let us see what happens when we are looking at the money. So when we enter at the money, suppose at the money is at 40 rupees and we are doing an intraday trade, then even if it moves from 2400 to 2450, we will just get 32 points, which is about 80%. But if there are 5 days left to expiry, then we will get 54 points only. That is, we will hardly get 24 more points from 40 to 54. Because time left for expiry is more, our return on investment will be less. And in case of out of the money, what happens? We enter at 8 and it moves from 2400 to 24550. What will happen? This has moved towards our OTM. So our OTM, the second order Greeks are now getting more value at out of the money. So it will move from 88 to 21. So that is approximately 260% return if you calculate. But if there are 5 days left to expiry, then in spite of 26, this movement from 2400 to 2450, since we are out of the money, we will be having a loss of 44%. If we go still deep out of the money and we buy it just at ₹1, then maybe if it is going to expire and it is an intraday trade, before it expires, it might go from 1 to 4, which is about 400% return. But if there are 5 days left to expiry and this goes from 2400 to 2450, but it is just 5 days left to expiry. There is not much time left now. So it might go to even 0, that is 100% loss in the premium. Okay, so this is how options work. It is not just the premium which is affected, it is also how many days to expiry are left. So here we are trading intraday during the start of the month where there is ample amount of time to expiry. Before 5 days of expiry, this scenario changes completely because theta decay starts happening on an exponential time frame. Got this? Now, we have seen this option chain and option chain how to analyze. We also get to see this in NSE website where we can see open interest and change in open interest on the NSE site. There are a number of sites. Now we also saw how we define directions based on option chain. Now coming to an important concept which is a put-call ratio. So what is a put-call ratio? Put-call ratio is divided into two things. One is put-call ratio based on volume and put-call ratio based on open interest. So for today's class, we are going to concentrate upon put-call ratio based on open interest. What do you mean by put-call ratio? Total open interest of put. All the open interest on the put side, like we saw here. Just a second. Yeah. So if you see, this is the open interest on the put side. So if we add all the open interest on the put side and all the open interest on the call side, we add both these. First, we calculate total put open interest by adding all the open interest on the put side. Suppose we get a figure. For example, let us suppose that after adding all this, we get 50 lakhs. And after adding all this, we get 70 lakhs. So what do? We calculate the put divided by call ratio. Put divided by call. Total put 50 divided by call. And this ratio is called as put call ratio. So if this ratio is less than 1, then we say that the market is bullish. Why? Because less than 1 means the call writers are powerful. The call writers are powerful. Call writers, call sellers, they are powerful. Therefore, this ratio is less than 1. Denominator is more. Denominator is greater. Therefore, the call writers are powerful. Therefore, the market is bullish. If put call ratio is more than 1, it means the put writers are powerful. Put sellers are powerful. So what are put sellers going to do? They will indicate a bearish sentiment in the market. Okay. Now moving ahead, there are certain values which we need to be very careful about. So these are the relevant thresholds which we take when we decide about the put call ratio. So the average put call ratio is near to 1. If it is near 1, it means it's an average ratio, it's a neutral ratio. If the put call ratio goes on decreasing, in the sense the put are increasing, it means that the level of fear in the market is increasing. Now, there is a general consensus that 0.7 to 1, if we are having the put call ratio, then we are in a bearish market. But if the put call ratio decreases below 0.75, below 0.7, then it means that the market is likely to bottom out and we should look for reversal. Getting this? Similarly, from 1 to 1.7, if the ratio is PCR is between 1 to 1.7, then we have a general view that the market is bullish. But if the ratio increases more than 1.75, it means that the market is now towards the extreme level of greed and we are supposed to wait for a reversal from the top. Now, this is just a general view and it doesn't mean that as soon as PCR goes 1.75, we should reverse our positions. Or if the PCR goes below 0.75, we should start buying call. But this, it can be used in consensus with the option chain analysis which we are doing, and we can get a confirmation of our market sentiment which we are getting from trend analysis of option chain. So if we are seeing that the put Y is decreasing and call Y is increasing, and we feel that maybe the market might go down, then we can confirm that view with what is exactly happening in PCR. So PCR, suppose at 9:30, if PCR was 1, we saw in our option chain analysis that call options are increasing and put options are decreasing. At 9:30, we again see what is happening to the put call ratio. So if the put call ratio, now calls were increasing. So what was our view? That maybe the market might go down. Now, if the PCR also starts decreasing and goes from 1 to 0.9, it means the total puts are decreasing as compared to the calls. So this gives us a second confirmation. So we can use it. Yes, we can use it like we use a second confirmation for our view. We can use this PCR as a second confirmation. Now there is another concept which is called as a max pain. So what do you mean by max pain? Let me show you that. So whenever we are trading in options, it is considered that option sellers are smart money, and smart money, they are here to earn the maximum profits. They enter market every day to earn profits. Now even we enter the market with the view to earn profits, but smart money have the power to move the options and move the market. So what is the point at which the smart money will get maximum profit? Depends upon where is the open interest converging of all the open interest of call and put side. So if you go and arrange call side open interest and put side open interest, this blue one is call side open interest. So this is open interest on the call side at 49,500. This is 49,000. This is 48,500. This is 48,000, so on and so forth. All the open interest on the call side, they are arranged from the right to the left, and all the put open interests are arranged from right to the left. The place where this convergence is happening is the area which is called as the max pain. This is supposedly the place where option sellers, the people who have sold options, if we consider that a single person has sold all these options, then the max profit this option seller will get will be if Bank Nifty expires at this level. Because this is a place where all these options will turn zero, all these options will also decrease in value. So this is the point of convergence, and this is called as max pain. So what do we do with this max pain? If you see, the max pain right now is 43,000. So if Bank Nifty expires close to 43,000, then the option sellers will earn the maximum profit. Now, tomorrow, if we consider that tomorrow we start trading and we see that this max pain has started decreasing and it has gone from 43,000 to 42,800. What does this mean? This means that the option sellers positions has changed, and now the option sellers will try to take the market from 43,000 to 42,800, because now 42,800 is the point where they will get maximum profit. So if max pain is changing and going down, then the general consensus of third confirmation which you can take, or a supplementary confirmation which we can take like PCR, is whether the max pain is also shifting. If max pain is shifting, then the market will also likely to move towards the max pain. So if max pain is 43,000 and if it is going down towards 4,800, then even the market will start trading towards 48. And the value of this max pain will have the greatest significance nearer to the expiry. Okay, before the expiry, max pain can be at a different level than the current market price. But as we come closer to the expiry, the max pain will give us a better judgment about where the market might close. Okay, got this? Is this concept clear about the max pain? Is this concept clear about the max pain? Yes. So with this, we have completed almost all the basic things which an option trader should know before starting to trade in options.